All right, let's talk about trading edge, but we're going to skip the usual stuff about win rates and P&L. Today, we're digging into the single biggest mental shift that separates a retail trader from a professional desk. And trust me, it's a difference that once you really see it, you can't unsee. Let's get into it.
You know, it all comes down to the question you're asking yourself. On the left, you've got the classic retail question: is my strategy making money? And look, it's a fair question, but it's all about what's already happened. Now look at the right. The pro asks, under what conditions does my edge just disappear? Now that is proactive. It's about survival. And honestly, this one little shift in perspective, it's the whole game.
So let's dive into that first part, the retail trader's trap. We're going to start by really exploring that common mindset, because it turns out the way most people measure if they're doing well, it's actually a trap that's designed to make you feel like you're making progress. Most traders, right, they are glued to these three things: their win rate, their overall P&L, and of course, how they did yesterday. Here's the problem, though. Every single one of these is a lagging indicator. It's a report card for the past. It tells you what happened, but it tells you absolutely nothing about whether your edge is still valid right now, this very second. This quote just nails it, especially for today's markets. Think about something like zero data expiration options, or zero DTE. That edge can be razor thin, and it can vanish in a heartbeat. So if the only thing you're looking at is yesterday's profit, you are flying completely blind. You don't actually have a system. You've got hope dressed up with some fancy option math. You're just hoping the math is still on your side.
Okay, so if looking at past results is a total trap, what's the alternative? What do the pros do? Well, that brings us to the core idea of this whole explainer. This is the concept that really changes everything.
And here it is. Pros do not think of edge as some static number like, oh, I have a 60% win rate. No, they see it as a live breathing condition, a mathematical inequality that has to hold true in real time. If it's true, they have a green light to trade. If it's not, the light's red. Simple as that.
Now, to really get that, we have to quickly talk about its main ingredient, expected value, or EV. The simplest way to think about it is this. If you made the exact same trade 1,000 times, what would your average profit or loss be after everything's said and done? That's your expected value. And this right here, this is the inequality. This is the whole shebang. It just says that your chance of winning times your average win minus your chance of losing times your average loss minus all your costs, well, that number has to be bigger than zero. If it's not, you have a negative expectancy. And that means you are mathematically guaranteed to lose money over time. For a pro, this isn't just a formula, it is their system. Okay, I know that might feel a little abstract, so let's make it super practical. How do the pros actually measure this? How does a real trading desk keep an eye on this inequality during the absolute chaos of a trading day? They track live variables that plug directly into that formula. So first, realize slippage. Are the costs to get in and out of a trade higher than they're supposed to be? Second, the loss multiple. Are my actual losses in the real world bigger than my perfect backtest said they'd be? And third, has the market's whole personality just changed? Any one of these can completely destroy the math. And this, right here, is where that professional discipline really kicks in. This is so important. If any one of those live variables makes the expected value dip below zero, the system is shut down, off. We're not talking, oh, let's reduce size or let's be more careful. No, it is off, period. The margin for error here is just razor thin. So let's look at a concrete example of just how ridiculously fast a profitable edge can completely vanish into thin air.
Okay, check out this table. At the top, everything's looking great. Our costs are low, our losses are what we expected, and our EV is positive. We have an edge, right? The system's alive. But now, watch what happens. As our costs from slippage just creep up a tiny bit, and our realized losses get just a little bit worse, bam! Look at that third line. A tiny increase is all it took to flip our EV negative. And just like that, a profitable strategy is now a money-losing machine. And that's the thing you have to burn into your brain. It doesn't take a market crash or some huge dramatic event to kill your edge. Sometimes it's just a tiny, almost unnoticeable increase in friction, like a little more slippage, that's enough to turn a winning system into a loser. So what does this all mean for you? It means it's time for a big philosophical shift. It's time to stop trading outcomes and start trading the math. Forget hope.
You see, when you adopt this mindset, it's not just theory. You get a practical, real-world toolkit. You get a measurable kill switch for your system that has nothing to do with your emotions. You get a way to test your edge in real time on every trade. And, maybe most important of all, you get a way to stop trading before the big, painful losses show up on your statement. This is how you start operating like a real desk.
So, let's just boil it all down to this one final comparison. Retail traders are obsessed with outcomes. Professionals? They're obsessed with the inequality. They know that if they just manage the inequality and make sure it stays true, the outcomes, the profits, they'll take care of themselves.
This is it. This is the simplest but most powerful rule in disciplined trading. The second the math tells you your edge is gone, you are flat. You stop. You walk away. You reevaluate. You don't sit there and hope it comes back.
And this should be your mantra. You don't stop because you're scared or frustrated after a few bad trades. You don't stop because you have a bad feeling. You stop because the math, the cold, hard, objective math, told you to.
So I'll just leave you with this final thought to chew on. What would it mean for your trading? What would it change for you if you had a system to actually detect that your edge was disappearing, to see it decaying in the numbers before your account balance ever took the hit? That, right there, is the power of trading inequalities instead of outcomes.